going here in part number 2 and showing you how we record business transactions. We're going to use our textbook illustration again, Smart Touch Learning, and record the transactions for the month of November, but unlike Chapter 1, not in accounting equation format, but we'll show you how we journalize our transactions and post them using the 5 steps we left off with in part 1 of this lesson. So here we are again with our first transaction, where Sheena Bright contributes $30,000 to start Smart Touch Learning. Looking at our accounting equation, cash is being increased by Smart Touch Learning, and the owner's capital account is also increasing because of the owner contribution. Because cash is an asset, cash will be increasing on the debit side, and because owner's capital is on the right-hand side of the accounting equation and increases equity, the capital account, the dollar amount, will be put on the right-hand side, the credit side. So here's the journal entry of that transaction, and let's walk through the format one more time. Step number 1 is putting down the transaction date, which is November 1st. The second step is we always list any accounts that are debited first. Cash is an asset being increased, therefore we put $30,000 on the left-hand side, the debit side of cash. Step number 3 is putting any accounts that are credited. The Bright capital account is increased with a $30,000 credit. And then the fourth and final step is to give a brief explanation so we know what this transaction is, and it is an owner contribution. Again, notice our basic accounting rule, our debit equals our credit. After we journalize the transaction, then we post it to the ledger. And again, post just means transfer. So we take the $30,000 to cash and post it to the left-hand side of the cash account in the ledger. And we take the Bright capital account, the $30,000 credit, and post it to the right-hand side of the capital account. Again, think of a ledger like a book, where everything on this page shows the increases and decreases in the cash account, and everything on this page shows the increases and decreases in the owner's capital account. Our fifth and final step is just to make sure our accounting equation balances, and it does. Cash increases on the left-hand side $30,000. The Bright capital account increases the right-hand side $30,000. So yes, we are in balance after this transaction. In our next transaction, Smart Touch Learning pays $20,000 cash, and they pay the cash because they want to receive land so they can use that in their business operations. When this transaction happens, notice it's 2 different asset accounts being affected. Land is increasing. Smart Touch Learning just received land, so land will be increased on the left-hand side, the debit side. Smart Touch Learning paid $20,000 cash. Cash is decreasing, therefore we'll put the $20,000 on the right-hand side, the credit side of cash. When we record this transaction in the journal, we start with the date, November 2nd. Land is listed first because we debit the land account for $20,000. Cash is listed second because that's the credit account. And again, notice we indented here to highlight it's a credit of $20,000. The fourth step is to write the explanation, and Smart Touch Learning paid cash for land. So now that we've journalized the transaction, now we post it. We transfer that information over to show that the $20,000 debit increases land, and the $20,000 credit decreases cash. Now just keep in mind, in real life, a general ledger is not just going to be a list of T accounts, but just for the purposes of our illustration, we'll use T accounts to represent the general ledger. Our last step is to make sure our accounting equation balances. And notice one asset, cash, goes down $20,000, while another asset, land, increases $20,000. So our total assets is $30,000, and that does equal the right-hand side, the Bright capital account, $30,000. So yes, our accounting equation does balance after transaction 2. Next is transaction 3, purchase of office supplies on account. And we'll go a little bit faster now since you're probably getting the hang of this. But Smart Touch Learning purchases office supplies, but they don't pay them cash now. Let's say they pay them within 30 days. When we do this journal entry, and we start with the date, office supplies is an asset. All assets go up on the debit side, so it's listed first, debit of $500. Accounts payable is a liability. Smart Touch Learning owes more money, So liabilities increase with a credit. So $500 on the credit side. And again, accounts payable is slightly indented to show that it's a credit. We write the explanation, purchased office supplies on account. And then we post this information to the T accounts, which represent our general ledger. Office supplies is increased with a debit. Accounts payable, that's updated with a credit of $500. In transaction 4, SmartTouch Learning earns service revenue by performing e-learning training services for a client, and the client pays them cash right away. When we do this journal entry on November 8th, cash is an asset. Assets go up on the debit side. $5,500 is what SmartTouch Learning earned. Service revenue is an equity account. It's a revenue account, and all revenues increase on the credit side, so that gets listed second with a slight indentation. We write the explanation, perform services, and receive cash for the services. And then once we do the journal entry, we update the general ledger by posting cash and increasing that account on the debit side, $5,500, and increasing our service revenue account on the credit side, $5,500. In transaction 5, almost the same thing happens, but this time the client does not pay SmartTouch Learning immediately for their services. Let's say they pay them within 1 month. So they earn service revenue on account. The journal entry starts with our date November 10th. Accounts receivable is an asset, and asset accounts go up on the debit side. So we have the right to receive $3,000 in the future. That's our debit. Service revenue is indented slightly because that's our credit. We earned more service revenue, so we get to book that. Is done, and we write our explanation, perform services on account. Now we can get to add $3,000 to our service revenue account in the general ledger. Next is the payment of expenses with cash. Here, on the exact same date, SmartTouch Learning is going to pay for 2 different types of expenses. They're going to pay for their rent and pay for their employees' salaries. Now, when we do the journal entry for this transaction, we call this a compound journal entry because more than 2 accounts are being affected. We still start with the date, November 15th, but remember, we list our debit accounts first. Rent expense and salaries expense are both, well, obviously expenses, and therefore they're going to increase on the debit side based on our debit and credit rules we learned earlier in this chapter. Cash is our credit because it's an asset account decreasing. Cash is slightly indented, so we credit the account for $3,200. So in this compound journal entry, our rules still stay the same. If we add our 2 debits together, it equals our 1 credit, $3,200. We still write an explanation, paid cash expenses, and then after the journal entry, we do post to update each of the 3 different T accounts in the general ledger. Cash is decreased with a credit, rent expense and salaries expense are increased with debits. So I know what you might be thinking right now. You might be saying, hey, I thought expenses decreased equity, but if we're debiting the expense, that records an increase to the account. How does that happen? Well, let's try to give you a decent explanation here. Yes, it is true that expenses decrease equity overall. That doesn't change. But here's another way of looking at it. An expense is increased and put on the debit side because the business now has more expenses than what it had before. Or in other words, think of debiting an expense account as if we're increasing a negative account. Maybe that explanation helps you out, but at this time, we will wrap up part 2 of our 4-part tutorial, and we'll see you back here for part 3 soon.